and welcome to another investment bond blog. I'm Marilyn Cohen, and I'm president of Envision Capital Management in Los Angeles. There's a lot going on in the bond market besides what you think is on the surface. What I mean by that is TOMA, T-O-M-A, takeover, mergers, and acquisitions. There's some reverberations going on, and I want you to be aware of them. Number one, even though interest rates are at generational lows, you would think that mergers and acquisitions and takeovers would be much more hot and heavy than they are. For some reason, they haven't been. But those that have been active have created big reverberations for individuals who own bonds of companies that are being taken over or are the takeover companies and or private equity firms that have already been taken over and are issuing lots of debt. Let's take the first things first. Let's say you owned Dell computer bonds last year before Mr. Dell said that he wanted to take the company private. Many of Dell's bonds do not have what's called change of control provisions. That means in the covenant protections, the company has decided that if the firm is taken over, your bonds will not have any protection. Some of the bonds do have protection and will be redeemed at 101 no matter what price they are in the secondary market. Well, what happened with Dell, most of Dell's bonds were not protected by change of control provisions, and lo and behold, the announcement was made. Even though Mr. Dell was going to put a ton of money in the deal, everybody knew that they would have to issue a lot, hundreds of millions of dollars of bonds. And what happened? Bond prices tanked for those bonds who had no COC or change of control provisions. Now, fast forward to other companies like BMC Software, in which there were change of control provisions when Bain Capital decided that they were going to take BMC private. But Bain Capital was only going to put in 15% of equity, so that meant, boing, immediately, we were going to have a lot of debt that was going to be overlaid on the bonds. So the change of control provision gave somebody protection, but if you bought the bonds at 110 or 111 and they were going to be taken out at 101, abracadam, you lose 10 points. Not a good deal. So why am I going through all of these mechanics? Well, basically because there's peril out there, ladies and gentlemen, in the fact that if you own corporate bonds in which your company is going to take over another company, like Dish Network, Dish the satellite company, whose subscribership is declining, just like DirecTV, just like Time Warner Cable, because people are going to other modems and computers to watch movies, etc. So what happened was Dish decided that they wanted to take over Sprint when the Sprint board had already accepted a takeover by SoftBank. So what happened to Dish bonds? Well, those that didn't have any kind of protection and covenants, number one, even though they were the acquirers, everybody knew, there's going to have to be a ton of new capital raised in the bond market to take over Sprint should they be successful. And all of the Dish bonds went down, and they went down dramatically, except for the short-term bonds. This can be very problematic. We own about 150, 160 different corporate bond names in our portfolios. Average investors own maybe 20 or 30. So if this happens to one or maybe two of your bonds, that can be problematic. What to do? Make sure that you have change of control provisions. Look in the prospectus under the covenants. Make sure that you stay on top of the news, because if your company is an acquirer or acquiree, it can all be bad news for you, and when in doubt, you need to get out. We're going to talk about other facets of TOMA in just a moment. Welcome back, everybody. Another unpleasant situation in bond land happens to be regarding private equity firms. Private equity firms have taken publicly traded firms private, and usually they issue, like I told you in the first segment, a ton of debt over the debt that you may own. And then sometimes we are seeing private equity firms, and this is happening now, go ahead and issue even additional bonds in order to pay themselves big, fat, juicy dividends. They pay it to themselves and to their shareholders. Over 50% of the bonds that have been issued by private equity companies this year in 2013 have gone to pay dividends. So what does that mean if you own the original bonds or if you want to buy the new bonds? Number one, don't buy those new bonds. It's kind of like taking a second out on your home and squandering it by buying a boat or taking a vacation. That has nothing to do with increasing the value of your home. Well, a private equity firm that's issuing new bonds to take money out to pay themselves and their shareholders does nothing for the company, the underlying company. In fact, it's problematic because it increases their leverage. Over the course of this year, the average rating on these private equity bonds to pay dividends has been CCC. We at Envision Capital only have one bond in our portfolio that is CCC rated, and that's a big turnaround name that we really like. I urge you to pick up the latest Forbes magazine, of which I've written a column and given that as a recommendation. So I would say keep it clean, keep it simple. What are the types of names you should buy? Names who are feeding into the housing market. Number one is Masco. Names who have been in the headline news, and the bad news I believe is already out, are the short-term Sallie Mae bonds. The Sallie Mae bonds that are going to kind of be in a self-liquidating company after Sallie splits off into two different companies. It's not easy out there in bond land. Buying AAA and AA rated bonds isn't going to give you any yield, so don't bother with them. You have to go down the credit quality system, but don't go to triple C's, go to triple B's, triple B minuses. Names, like I said, Masco and Sallie Mae, I think will be money good. Keep it short. Buy bonds that are shorter than 2020 by 2017, 18, 19, and I think the yields will be very, very well worth it. I'm Marilyn Cohen. Thank you for joining me.